Welcome to Mark Arnold's Finance. I cannot believe we're already in November. The year's almost done. So it's time for me to share what stocks I'm going to buy now in the month of November. A lot of people are saying very negative things about this year as far as investing goes. But I think it's a very positive year for investors that definitely have a long horizon till retirement, like myself. This is the time we get to add companies at great valuations. We get to accumulate, so when it does turn around, those stocks and profits will prop up and it'll make us smile a little bit more than we have been due to all the other things going on in the economy and this world. So what I want to say is, if you're new to my channel, I'm somebody that is very transparent, meaning I share my portfolio performance with every single video. I share my failures, my successes, and a lot of diverse content. I'm learning, so I'm sharing that with you guys as I learn. If you like that type of content and the transparency, be sure to subscribe, follow me on this journey, because it's a journey we all can grow together on. So let's start with that transparency and look at my performance of my portfolio. I am down 7.5%, so a little bit more in the red than last time, and I'm down $3,500 in unrealized losses. If you're new to my channel, you'll see each individual holding I have. And if it's in the red, it's making me a loss. If it's in the green, it's making me a profit. Underneath that in purple is the allocation by market value of my portfolio. So Microsoft, for example, is 13.9% of my portfolio based on market allocation, so it's a large holding, whereas Cisco, a few down, is only 2.72% of my portfolio. So hopefully this will help. We'll see here, technology's definitely hurting me. They're down in the red. They're bigger holdings. Financial stocks as well, like T. Rowe and Ally. And that should be a little bit of a hint of what stocks I'll be buying in November. But before I do that, I was able to find on the brokerage that I have my stocks on, the platform, comparing my portfolio to the S&P 500. And to my surprise, this made me smile a little bit more, but I'm actually beating the S&P 500 with a 1-year rate of return. So over 1 year, as of September 30th, 2022, my portfolio is down 14.98%, where the S&P 500 is down 15.47%. So I'm beating it by half a percentage point. That is really cool because a lot of people benchmark their portfolios versus the S&P 500. And the fact that I am beating it just shows that I am doing something right, at least. Maybe not everything, but I am doing some things right. So I will use this and update you guys with this because I think it's something neat to track. Of course, October is a month where tech stocks did go down pretty heavily, and though there's a lot in the S&P 500 as well, so it'll be interesting to see how that plays out. So I will share that with the next video. But let's dive into this video sharing with you guys the 5 stocks I plan on buying. Each stock, we're going to go through these quickly. I'm going to share the fundamental analysis, the profit margins, the returns, and the debt of these companies, and maybe a little bit extra. So the first stock I want to share with you is Microsoft. Microsoft is a boring, high-quality company, and it did just beat on its earnings and revenue, and this is something that's typical of Microsoft. They're a high-quality company. They're a very high subscription-based company, so they have a lot of reoccurring, dependable revenue, and as of now, this company is down 31% from its all-time highs, something that is extremely rare for Microsoft. I feel this company will be around the rest of my life. I feel they'll keep growing in market share, in their margins, etc. So let's take a look at a few of the things with Microsoft. We will see here with the fundamental analysis. Microsoft, as I've said, it's rare, but they're considered highly undervalued. They're of high quality. I was surprised to see this, but then it kind of made sense because I was looking at other tech stocks, but they have low growth stability on this rating. And then they have decent financial health. So the growth stability is really its earnings and cash flow growth. And so they're seeing that as something with Microsoft and other tech companies that is hard because you have a strong dollar. And with big global companies like Microsoft, they make a lot of their money overseas. And when they transfer that over to the strong dollar, they're losing a lot of money. Of course, with interest rates going up, we've had a few years of near zero rates where these companies can borrow. Now that that's going up, any future money that these companies borrow is going to be expensive. So I think that's what this graph is getting at with the low growth stability. If we look at their profit margins, Microsoft, this is what I mean by high quality. Most of their margins are in the top 99 to 98th percentile, even 100. compared to their industry average, which is the software industry. And Microsoft just kills it here. So profit margins are important because it's the sales that these companies make and how much they get to keep in earnings off of those sales. And gross margin, you look at the profit margin, the operating margin, all these are very healthy with Microsoft, so that is great to see. If we move on to their returns, we will see here, again, this company is stellar. It's one to benchmark off of for other companies, and returns are basically profitability. It's the money that they're making or losing on an investment, and Microsoft definitely knows how to make a return on their investments, whether it's their assets or equity or their investments, they can make returns off of these metrics. So very, very awesome to see, and why I'm so bullish on Microsoft. And if we look at their debt, Microsoft has average debt, of course, compared to other companies, it's low. You look at their total debt to assets, it's only 22.7%. You compare it to the industry average, it's more in mid to a little bit above the mid-range, which is good, but something that this company can easily get through any type of recessions or downturn. Companies that are over-leveraged, meaning they have too much debt, they're the ones that are going to suffer the most during hard times. So Microsoft having low debt overall is a great thing for you and I and whoever holds this company. So as I said, Microsoft is down 31%. It's now sitting at about $200 in the high $20 range, so $229 we'll say. I believe this company deserves to be at about $290 because their PE average is about, right now their PE is 25, their average 5-year PE is 35, so they're well below their average. For a high quality company like this, I think they at least deserve to be at a 30 PE, which is about $290. So Microsoft is a high quality company I will be buying. And next up, I plan on buying Amazon. Now Amazon, they did miss on their revenue. This company has some different challenges because they're basically really open to advertisement revenue. People in a recession are going to pull back on spending, which Amazon is big on people going and spending on their site, their app, their Prime subscriptions, stuff like that. Even though I think they're very sticky, people do pull back when they're having a hard time, and I think Amazon is going to see a little bit of pushback from that. But they do have sticky products. Their subscriptions very sticky. Amazon, everyone I know basically says I order off of Amazon, right? So they are down 44% from their all-time highs, and we will see here that Amazon's fundamental analysis, Amazon is considered a little overvalued, though I disagree with this. I don't think they are factoring in enough of Amazon Web Services, which is a ginormous part of this business. They are considered high quality. That low growth stability is what I talked about already with Microsoft, and their financial health is kind of in the mid-range. So with Amazon, we will see that their profit margins are great. Microsoft's are higher, but these are definitely towards the high end overall, and their returns of Amazon are the same thing. They're also towards the high end. That's important in a company. These metrics are what I'm looking at most, and so that's why I'm bringing these up. Now, the debt of Amazon, I think is pretty healthy at a 36.16% of their total debt to assets. Though they're towards the higher range in their industry average, overall it's still a low percentage. I see companies over 50%, and that's the red flags that I have, because during hard times, it's those companies that will go under and go out of business. Amazon, not going to happen. This company's huge. It has a huge moat. Amazon Web Services, I think, is its big opportunity and saving grace. And so what I will say with Amazon is it's now below at 100 or a little bit below that. I believe it dropped to the $90 range today. I really do think this stock should be about 140 when I factor in its PE ratio. So when economy does turn around, I think this stock will definitely head up towards the 140 range pretty quickly. And you just got to look at Amazon. Almost everything they touch becomes successful. Their Whole Foods sector. When I went over their earnings, let's say this, every portion of their company is growing very healthy. And that says a lot. So while their stock's tumbling down, their business is still doing well. Yes, they're having some issues with their earnings because expenses are high, but that's with a lot of companies, and especially with a company like Amazon with fuel costs to deliver all those goods. Things like that are going to hit them harder than other companies. So I feel now is the time where Amazon is seeing the worst of the worst, and it's the time that I want to get in and add on Amazon. Next up is Meta. Now, Meta missed earnings per share pretty big. They actually beat on revenue slightly, but this company's problem is they're highly focused on ad revenue, which is taking a hit everywhere. And the only one that kind of escaped that was Amazon. So that's another positive with Amazon. Their ad revenue is stellar compared to these other companies, the way that they have it set up in their app. But regardless, Meta is having some transition pains right now with turning some of the focus to the metaverse. They also recently had Instagram that went down, so that sent the stock tumbling. People love to react, right? And it's down 75% from its all-time high. This stock has gone down massively. So with Meta, we will see here that the analysts consider this company highly undervalued, of high quality. Of course, the low growth stability we're seeing with all the tech companies, and it has a lower financial health. And I think that should be just because there's a lot of transition and expenses going into the metaverse, which that is something I totally respect. If you are not bullish on the metaverse or don't believe in it, that is fine. I see it a little differently. I've made some videos on it, and that's just how I feel. So with Meta, if we move on to their profit margins, we'll see here they have stellar profit margins. This company definitely does well there, as well as their returns. And so when we get to their debt, we will see here that they're similar to Amazon, where they're kind of in the mid-range of their industry, but they're still low overall. And they're lower than Amazon, right? Amazon was in the 30% range. So I think financially this company is set to weather any storm. And so while this company's getting hammered, I feel now is the time to buy. I know I keep saying that and then it goes down another 10, 20%. But I think eventually this company will get a handle on what it's doing. It'll turn around and should make me some very attractive profits. So it's now at about $93 or so. I think it's hard to measure this company. So I'll just tell you that analysts range this from $80 to $292. So I think it's a stock that is confusing many. A lot of people are reading it in many different ways. And so I'm very hopeful that this company, after a few years, will start showing the positive investments, returns on its investments with the metaverse. And that's just how I feel. So next up is Rowe. Now, Rowe did beat on both their earnings and revenue. And this is a company that is down 52% from its all-time highs. It's an asset management company. So during harsh economic times, of course, the stock will go down because people aren't investing, they're selling. It's just very predictable company. When the economy roars back, so will this stock. So that's one thing I really like about Rowe is I feel definitely now is the time to add and collect a healthy dividend. If we look at Rowe's fundamental analysis, we'll see here they are considered undervalued, of very high quality, that low growth stability. Now I know the tech sector is feeling it, but with an asset management company, it makes sense because people aren't really going to focus on investing in times like this. A lot of people freak out and they sell. And then their financial health is a little lower in the mid-range. But I will point out some important things here now that we look at some of their other metrics. So their profit margins are decent compared to the industry average. Overall, they're well, though. Very good, shall I say. With a gross margin of 44%, that's really healthy. The profit margin is at 24%. You look at the industry average of 11%. This company, I believe, is above its peers in a lot of areas, and we'll see here their returns are stellar. Now, when it comes to debt, I'm happy to say they basically have no debt. This company is not leveraged. It's something that I like to see. It's going to weather this storm just fine, so it's a company I'm happy adding to. It's now nearing $100 a share, and I think that when the economy turns around, this is a company that will sit above $200 per share. So you could 2x your money, let's say in a year or two. Who knows how long that this possible upcoming recession will last or these hard economic times, but I think it will turn around. Next up is Ally Financial. Now this stock, I will put a disclaimer up, I bought recently. It's down for me, And I did let you guys know this company has a big risk. It's heavy in the auto loans, and the auto industry right now is seeing some pains with prices of cars staying high. With interest rates going up, people are going to default on their loans. And so Ally is a risk, but it is very inexpensive. It has a very, I think, attractive valuation. So its PE right now is half of its 5-year average. So it's got cut in half. It's down 49% from its all-time highs. And we'll see here that its fundamental analysis is considered highly undervalued. It's considered high quality, and that growth stability is more towards the higher end than the lower end, as well as its financial health. So it has some good fundamental analysis on this company. And if we look at their profit margins, this is where it gets a little sticky. They are kind of a little all over the place, low in areas, high in others. But this is a hard time for this company. And if we look at the returns, they are towards the low end. So this is kind of the negative for me with this company, and one that I hope will turn around when the economy turns around. But what I like to see with Ally is they're low leveraged. You look at their total debt to assets, it's at 11.6%. The industry average is 19.64. So this company, I feel, can weather this storm. It's got a great business model. It's a great company. I do utilize this company myself. So it's now in the upper $20 range. I feel this company could easily move up to $35 per share at the very least upon any kind of good earnings in the future. So there you have it. You have these 5 companies, Microsoft, Amazon, Meta, T-Rowe, and Ally, that I plan on buying in November for the main reason that they are down massively. I consider them quality companies, each in different ways. Microsoft is of the highest quality to me. I think T-Rowe is a high quality company. I think Amazon's a high quality company. Meta's in a transition stage, but it still has great financials, makes tons of money still. And Ally to me is a company that I feel is just so inexpensive, I'm willing to take a chance on it. What I will say, when you looked over 2020 and 2021, when the stock market was rallying massively, people were dumping in mainly to tech stocks at the time. And then now that the economy's turned around, people are wanting to be out of tech stocks. So if you look at that, when the tech stocks were going up, is that the time, now looking at it now, that you would want to buy? No. But now that the tech stocks are down, this is the time to buy. But it's funny how people react, right? They buy up here, they stay way down here. But why wouldn't you want to add here to the companies that you feel are of high quality and that you've researched? Because when things flip back around, those companies will rocket up, I feel. And that's just what I can take a step back and look at. And there are more good times in the stock market than bad times. I've shown this chart many times, but there's more expansion times than times where the stock market is going down and in the red. And so you want to be a part of those expansion times, but you want to have been prepared for them by buying in those dips, those down economic stock market times, because then it'll propel you up like a rocket ship. So let me know what you thought of my 5 stocks. These stocks are ones that I'm very hopeful and bullish on. I've done a lot of research videos on these companies, and I want to keep on buying them. So though these might not be different companies from prior months that I plan on buying, that's just me being honest. I'm still adding up on these stocks, and of course there may be others I buy. It just depends. This month can definitely be volatile and present different opportunities. So I'd like to know what stocks you plan on buying in November. And I just want to encourage you guys. This really is, in my opinion, accumulation time to add to your portfolios. Yes, mentally you can look at those red negative numbers, but just keep your eye on the long-term goal and you'll look back and be grateful that you added now. So have a great day, everyone, and we'll see you next time on Mark Arnold's Finance.